Hey everybody, welcome back to Matt Money. It's your boy, Uncle Matt. So, hope you guys are staying safe during these really trying times. But it's been a while since I gave you guys an update on the M1 portfolio aspect of things, and so I just wanted to take a quick moment and do so. So, you can see that the portfolio is up to about $18,000. I think I started this portfolio in June or July of last year with about $5,500, and then I made a promise to myself to get this to about, I would say, twelve to $20,000 by the end of 2020, and we're obviously on track to kind of get to that upper end of that goal. And I think a lot of it has to do with a little bit of the changes that I've put into my strategy over the past couple months. I've obviously hit some really good goals over the past year and a half associated with my dividend income and things along those lines. So, what I've really tried to do, and you'll kind of see that mixture here in this portfolio when we go into M1 a little bit, but you'll see that I've kind of started to lean more towards an ETF passive route to kind of balance out the portfolio a little bit. I'm really ETF light in terms of the portfolio, and I guess you could say very quickly that the portfolio is about 540,000, and way less than 10,000 of that I would anticipate at this point is in ETFs. And so, what I want to now start to do is kind of take the foot off the gas pedal on the individual stock investing and really move that sort of fuel over into the ETF pile. It's going to make things a little bit easier for me in the long run, and also I think it's just going to be good for overall growth because as I've gotten more dividends into the portfolio and out of the portfolio, I've kind of met basic expenses that I would really need over the next couple of years. And if I were to say, unfortunately, lose my job in the near term, I could take whatever money I get from that and invest that into dividend stocks, and then I'd really be honestly covered in the basic income side of things if I were to have to say move back to the states and kind of live on my own, and kind of live off my dividend income. So now what I'm really starting to focus on is really the growth aspect of the portfolio. Um, Now the fact that I kind of have secured that basic level of income that I would need, so I didn't necessarily have to go hungry in the case of say being laid off. So just kind of jump into the portfolio here. You can see over the past year or so, we've gotten, let me just do a quick year, 15% return over the past year. All time we're at about 20%. So this is dating back to the September-ish time frame of last year. So looking pretty good in terms of that. 15% if you're looking at the past year. But really starting to increase very heavily, I would say, over the past, I guess, 2 to 3 months. And I'm actually continuing to increase the automated investing aspect of this portfolio. I did start off with about 500 a month, I think early in 2020, and then I moved it to 750 a month, and now I'm actually going to move that to about 1,000. Sorry, I'm gonna have to edit that part out, but I was doing $500 twice a month. Then I moved that originally, from 500 a month to 700. I was originally doing $500 twice a month, and then I started transitioning that to $750 twice a month. And now, actually, what I've done is moved it to $1,000 twice a month. So basically, every time I get paid, I should be taking $1,000 of that and investing that directly into this portfolio. So the first thing you'll notice here is that there's 6 positions within this portfolio, 3 of which are ETFs and 3 of which are dividend stocks that I really enjoy. Visa is kind of a dividend growth stock, but it's really a growth stock at heart. But there is massive dividend growth coming out of Visa. It's just such a low yield that, and the price of the stock just keeps shooting up, that the yield is just so small. So anyway, I really like the stock, and I think it's going to continue to grow, especially as digital payments and things like that continue to advance in the coming years. But I also have Johnson and 3M. I think those are also phenomenal dividend growth companies and staples in any sort of portfolio, most specifically Johnson. But what I've really started to transition the portfolio to is kind of a ITOT, which is a total U.S. stock market fund, and a QQQ sort of fund, which is the NASDAQ 100 for those of you guys that are unfamiliar. And that's going to now be the majority of the portfolio once it's fully running and up. And then a little bit of the income will be coming from QYLD, which is actually like a QQQ in terms of the NASDAQ 100, but they write covered calls on it. So it's relatively active in terms of what actually is coming out of it. But it basically has a lot of the underlying stocks in the NASDAQ 100, and then it writes covered calls against those positions to give you about a 1% yield, 0.8 to 1% yield every single month. So it's really good, but also keep in mind that there is a higher expense ratio to this stock just based off the fact that it is relatively actively managed. So it's not going to be lower sort of expense ratio as like your ITOT or your QQQ. So another thing that you'll immediately notice here is the actuals versus the target is relatively out of whack. So you'll see the Visa, Johnson & Johnson, and 3M are about 18%, 18%, and 16% respectively there, where their target now is about 1%. So you'll see 1% for Visa, 1% for Johnson & Johnson, and 1% for 3M is now their target. So this originally was about 50-50, Johnson & Johnson, 3M, then I added Visa, then I was 33, 33, 33. And then once I added in these ETFs, I kind of switched the strategy and said, you know what? I do like the Visas, Johnson & Johnsons, and the 3Ms of the world. I do still want to get those dividends, but I'm going to take those dividends and kind of put them into ETFs and kind of get that growth over the long term. And so that's been the near term changes that have really happened that I'm hoping to set up for the long term. So what then you'll notice is the ETFs that are now in the portfolio are about 14% for QYLD. So this is the income aspect of the portfolio, and I'll dive into this in just a moment. And then you have ITOT, which is a total stock market fund. That's 42%. And you have QQQ, get a little bit more of that technology exposure, which I have very little of, aside from Google and Amazon in my own individual portfolio, or individual stock part of the portfolio, I should rather say. And so that will continue to ramp up. QYLD, I threw $2,000 in that relatively recently. I just kind of wanted to get that up and running and kind of get those monthly dividends kind of up there. I'm really still trying to hit that $14,000 in dividend income for 2020. So those of you guys that don't see the rest of the portfolio, make sure to check it out. I'm really trying to hit that 14,000 this year. I did have some dividend cuts that really put a hinder on that, but overall, I'm thinking we're going to be able to get to it when it's all said and done. So for those of you guys that are unfamiliar with QQQ, it's a relatively healthy sort of fund, NASDAQ 100, so heavily weighted towards your Apples, Microsofts, Alphabets, Netflixes, Teslas of the world. And you know, it's not too bad in terms of what you're getting. It's not necessarily there for dividends if you're kind of seeking for that, but it is there for growth. So I have started investing in it back in like the late April timeframe. You can see just from there, since the late April timeframe, I'm up about 19%. So keep that in mind. That is right after, you know, a month and a half after, you know, everything started really happening with the recent downturn. So that obviously makes a little bit more sense as to why that might be up, say, 19% or more in the short term. Then you also have ITOT, which is something I've been investing in as well. This one has a little bit more of a normal yield, kind of a little bit less than 2% there. And the expense ratio is really low, 0.03%. So you're basically paying negligible amount of dollars just to have your money in there. But the dividend yield is nice, 1.75%. You can't complain with that. And I think it'll relatively stay consistent. The market will continue to grow. And what I've generally seen is over the past, say, 10 years or so, it's kind of hovered anywhere between 2.5%, all the way down to like 1.5%. So I think a lot of it has to do with the fact that if, you know, the market's really growing at a pretty quick pace, then I think you'll be in the lower end of that range for ITOT. Then you have QYLD. This is the big dividend rainmaker here. You can see this big jump up that I had of the $2,000 that I added here in the early September time frame. And what this is basically looking at is just under 1% return in terms of dividends every single month. And so this is going to be what kind of gives me that extra dividend yield coming from this ETF aspect of the portfolio. But you can see it does have this 0.85% expense ratio. So I think what I'm going to do, and another reason why, is I still want to kind of trial this out. It is about a $3,000 position at this point. but hopefully we'll be getting about $30 now, since I've kind of doubled down on the position. So hopefully about $30 a month now, coming from QYLD. And I don't think I actually updated this in my portfolio, because I think I'm still supposed to be getting like, I don't know, a little bit less than that. But anyway, should be getting about 30 bucks every single month from QYLD, and that'll go straight back into reinvesting into whatever it is. So at the moment, undervalued or underrepresented in the portfolio. So at the moment, that's ITOT and QQQ. So other ones, just to get us like a quick look at Visa. All time, I'm up about 21% from Visa. Started investing in that back in the October timeframe last year, and yeah, that's been a steady one as well. I mean, currently it's running a little hot in terms of the valuations, but I still think that it'll be able to grow into that. I still think that, Visa as a payment provider throughout the world is still relatively in its infancy, and I still think cash is really prominent throughout the world. So I think Visa will continue to dominate that market share as it continues to expand internationally. Then you have the dividend yield of about 0.57%, which is not great, but at the same time gives you a little bit of that extra oomph, and hopefully be able to get a couple more shares over the course of the lifetime just by that bad boy. Johnson & Johnson, staple in anybody's portfolio, man. 2.6% yield, can't complain with that, and it's always going to hover around this 25% PE ratio here. You can see it's kind of been kind of flat ever since the pandemic kind of came into play. Peaked down below $2,500. Now it's kind of coming in back up here in terms of what we're looking at for the actual value of this position. So overall, it's still up about 20% from what I was kind of buying it at. I think a lot of it has to do with the fact that I was buying during these dips here in March timeframe, and also buying it since it's been kind of going up since late 2020 or 2019 as well. So can't complain with that one. And then you also have 3M. Let's just take a quick look. This one's only up 10% since last year, September timeframe. And once again, this one is kind of for the dividend, right? 3.5%. Can't complain with that at all. A little bit lower of a PE ratio, and actually relatively recently, 3M is kind of coming back up in price. I was pretty surprised by that. But at the end of the day, still not a great, I guess, purchase for, say, growth or anything like that. But I am buying it for the stabilized dividends. They do have great portfolio of products. Think Scotch tape, think basically anything, and 3M probably has their fingers in it, and they'll be able to supply that dividend kind of going forward. Great free cash flow coming from this organization, but I would say right now it's probably a little bit rich in terms of valuations. Maybe wait for a little bit of a dip, maybe 10% or so, to be able to pick up shares at an even better price. But I think it's a great company to have in the portfolio. I have this in, was it two of the portfolios now? So M1 Finance, obviously, and then I think I have it in my individual brokerage account as well. So overall, it's a pretty decent amount of shares. Should be getting dividends from this bad boy actually today, but M1 Finance generally waits a day or so before you can actually kind of get those dividends. So I expect before tomorrow, it'll be met by this Johnson & Johnson dividend here, about 21 bucks, and that'll both probably go into ITOT and QQQ, just based off the fact that those are the only two at the moment that are underrepresented in this portfolio. So anyway, just wanted to give you guys a quick overview and maybe give you guys a quick show of the transfers that I have set up here, so you guys can see I basically have the $1,000 going in twice a month, and so I should have another $1,000 going in tomorrow because I get paid tomorrow. And with that, I will then be able to buy some more ITOT and QQQ. I plan on kind of keeping that for the near term and probably even the long term. I honestly think that those are two funds that I honestly want to contribute to for the next 20-30 years. And so unless something changes, like I want to say switch the strategy and sell off some of this portfolio and go into some real estate, then I think that this is going to be good. And M1 Finance, I think, is going to be my preferred investment for ETFs. I do also have ITOT in my YouTube Moolah portfolio. So if you guys follow this channel a little bit, you'll know that every dollar I make from YouTube, I put back into the portfolio and track it separately so you guys can see that. And actually, I should probably make a video. It's been a while since I made a YouTube Moolah portfolio video, but Currently, it's just sitting in 1 share of Amazon, and the rest is in ITOT. I think it's like 40 shares of ITOT at this point. So pays out pretty good. The dividend isn't great. That's 1.75% yield, but at the same time, it's a total stock market fund, so the overall growth for the long term will be really good. But just wanted to share this quickly with you guys and show you what's possible with M1 Finance, what I'm doing with it. It probably is a little bit different than some of the other YouTubers out there that are investing in, say, 20, 30, 40 different companies. I have those positions in my individual brokerage account, my Roth IRA, my computer shares accounts, and Robinhood. So if you guys are interested, make sure you check out some of those other videos, either in the sidebar if it's up there, or just check out Matt Money and subscribe to the channel. And I'm sure some of the videos will pop up eventually. So there's $540,000 in the portfolio. This is only 20,000 of it. So just make sure you guys have that ability to see the other different pieces of the portfolio and see that this isn't just the only thing. So anyway, guys, I'll check you guys in the next video. Good chatting with you, and I'll talk to you guys soon. Cheers.